Solana processes 65,000 transactions per second, Ethereum processes 30, Bitcoin processes 7, speed matters, and in 2026, Solana is where some of the most interesting crypto activity is happening. Here's what it is, what AI says about it, and what a regular person should know before touching it. I'm covering Solana the same way I cover everything on this channel. Plain English, AI analysis, honest risk assessment. So, what exactly is Solana? At its core, Solana is a blockchain, which is a type of digital ledger. Think of it as a shared, unchangeable notebook that records transactions in a secure and transparent way. It's what's known as a Layer 1, or L1, blockchain. This means it's the fundamental architecture, the base layer upon which everything else is built, much like Ethereum or Bitcoin. But while it shares that foundational role, Solana was engineered from the ground up with one primary obsession: speed. To understand why this matters, you have to look at the problems faced by earlier blockchains. Ethereum, for all its power, can sometimes feel like a congested single-lane highway during rush hour. When too many people try to use it at once, the network slows down, and the cost of using it, the gas fees, can skyrocket. This makes it impractical for small, everyday transactions. You wouldn't want to pay a $20 fee to buy a $5 coffee. Solana was created to solve this exact problem. Its goal is to provide the speed and low cost of a centralized payment system, like Visa or MasterCard, but with the decentralized and permissionless nature of a blockchain. The secret to Solana's speed lies in a handful of core innovations, but the most famous is a unique mechanism called proof of history, or POH. Now, this isn't a consensus mechanism like proof of work or proof of stake. Instead, think of it as a cryptographic clock. Before transactions are even bundled into a block, proof of history creates a verifiable, ordered sequence of events. It essentially timestamps everything, creating a historical record that proves one event happened before another. This is a game changer. On other blockchains, validators have to communicate back and forth extensively to agree on the order of transactions, which takes time. With Solana's proof of history, the order is already established. Validators can trust the timestamp and process transactions in parallel, without waiting for confirmation from the entire network. This ability to handle multiple tasks at once, known as parallelization, is like having a multi-core processor for a blockchain. It allows the network to process an extraordinary number of transactions simultaneously. The result of this architecture is breathtaking speed and incredibly low costs. While Ethereum might charge you anywhere from $5 to $50 in fees for a single transaction during peak times, Solana typically charges less than a penny. We're talking about a fraction of a cent. This isn't just a small improvement. It's a fundamental shift in what a blockchain can be used for. Suddenly, microtransactions become not just possible, but practical. This opens the door for a whole new class of applications. Think about in-game economies where you can buy and sell items for pennies, decentralized social media where you can tip creators tiny amounts, or real-world payment systems where you can buy that coffee without worrying about the fee being more than the drink itself. By focusing relentlessly on throughput and cost, Solana positions itself as a blockchain built for mass adoption and high-frequency use cases that were previously unimaginable in the decentralized world. So, how do serious investors, especially those using AI-driven analysis, decide if Solana is a worthwhile investment? They focus on fundamental signals that indicate the network's true health and growth potential. We've trained our models to track 3 primary pillars for Solana, and these are the same metrics you should be watching. The first, and arguably most important, is developer activity. This is the lifeblood of any blockchain and a leading indicator of future innovation. We track this by monitoring active developers, code commits on platforms like GitHub, and the rate of new project launches. A growing developer base means more applications and a more resilient ecosystem. After the FTX crisis, many predicted a developer exodus. But data from sources like Electric Capital's developer reports show that Solana has not only retained but significantly grown its developer community, a powerfully bullish signal. The second pillar is transaction volume, but with a crucial distinction. We filter for real usage, not just speculative noise. Our analysis focuses on non-vote transactions and daily active users. This tells us how many people and programs are actually using the network to do things, swapping tokens, minting an NFT, or sending payments. This metric demonstrates product-market fit. Is the network a utility for real-world applications? The steady rise in genuine user activity on Solana, especially in areas like decentralized physical infrastructure networks, or DePIN, points to an expanding utility beyond finance. The third pillar is ecosystem expansion, the direct result of the first two signals. A healthy ecosystem isn't just about having 1,000 versions of the same DeFi protocol, it's about diversity. We look for growth in distinct sectors: finance, gaming, social media, and physical infrastructure. The more varied the ecosystem, the more resilient it is. The launch of the Saga phone, while a niche product, was a strategic move to deepen the integration between mobile and blockchain, signaling a long-term vision. All three of these signals have been trending decisively up for Solana. But this upward trend doesn't erase a difficult past. To understand Solana's risk profile, you have to understand its history with the collapsed crypto exchange, FTX. In 2022, the catastrophic failure of FTX sent shockwaves through the industry, hitting Solana particularly hard. The connection was deep. FTX and its sister firm, Alameda Research, were major investors and key builders in its ecosystem. The collapse locked up a significant portion of the SOL supply held by the FTX estate, creating massive uncertainty. The price of SOL plummeted by over 95% from its all-time high, and the narrative shifted overnight from Ethereum killer to FTX coin. The recovery from that moment has been a testament to the community's resilience. The network didn't just survive the forced decentralization away from FTX's influence, it arguably became stronger. The price has recovered significantly, and the fundamental metrics we discussed have all surpassed their pre-collapse levels. However, that association is now permanently woven into its history. It serves as both a cautionary tale and a badge of survival that investors must weigh. Now, for the most important part of any investment analysis, the honest risk assessment. No technology is perfect, and ignoring the downsides is a recipe for disaster. Our AI model flags several critical areas of concern for Solana that any potential investor must understand. First and foremost, the elephant in the room: network stability. The honest risk assessment from AI. Solana has had multiple network outages, periods where the entire blockchain went offline. This isn't a minor glitch. For a network positioning itself as a global payment system, going dark is a catastrophic failure. These outages, often lasting for hours, were caused by a range of issues, from novel bugs in the consensus mechanism to overwhelming demand from bots during popular token launches, which created a transaction storm the network couldn't handle. This is a serious reliability concern for a payment system. Each outage erodes user trust and calls the network's fundamental architecture into question. So, what's being done? The Solana Foundation and ANZA, the new developer collective, have been aggressively tackling this. They've rolled out significant software updates to improve transaction handling and network stability. A key development is the implementation of local fee markets, designed to prevent a single hot NFT mint or token launch from congesting the entire network. But the biggest long-term solution on the horizon is FireDancer, a completely new validator client being built from scratch by Jump Crypto. Having a second independent client drastically reduces the risk of a single bug bringing down the whole blockchain, creating a much more resilient and robust system. The second major risk is centralization. A core promise of blockchain is decentralization, power distributed among many, not concentrated among a few. Solana faces challenges here. Running a validator node, which is essential for securing the network, requires high-end, expensive hardware. This high barrier to entry means fewer individuals and organizations can participate, leading to a concentration of power. We can measure this with something called the Nakamoto coefficient, the minimum number of validators that would need to collude to compromise the network. While Solana's coefficient has been improving, it remains lower than Ethereum's, indicating a higher degree of centralization risk. This concentration also extends to physical data centers, where a significant portion of validators are hosted, creating potential single points of failure. A third, more subtle risk is MEV, or maximal extractable value. Think of it as a hidden tax. validators have the power to reorder or insert transactions within a block they are producing. They can use this power to profit from user activities, like front-running a large trade on a decentralized exchange to capture the price difference. On Solana, this has become a significant issue, with sophisticated bots and validators extracting millions of dollars from everyday users. While MEV exists on other chains like Ethereum, its high-speed nature on Solana creates a unique and fiercely competitive environment. Solutions are being developed, but for now it represents a real cost and a poor user experience for traders on the network. So, after weighing the incredible speed and low costs against the significant risks of outages, centralization, and MEV, what's the final verdict? The AI assessment: Solana is a legitimate Layer 1 blockchain with real adoption but is a higher risk hold than Bitcoin or Ethereum. Its potential upside is matched by its technological and operational fragility. For a regular person building a diversified crypto portfolio, a smaller, more speculative allocation is appropriate. We're talking a maximum of 5–10% of your total crypto holdings. This allows you to capture potential upside from Solana's growth, while containing the downside if one of these major risks leads to a significant network or value impairment. It's a high-risk, high-reward play, and it should be treated as such. If you want to buy Solana, I've linked Coinbase in the description. They make it straightforward. Subscribe. Next week I'm covering how to evaluate any new crypto project using an AI checklist before you invest.